And we are live. Last night, I did a live stream where I discussed quantitative easing. I explained to you how quantitative easing affects the financial economy and the real economy. But when I went back and I rewatched the live stream, I noticed that I made a few mistakes, and I also realized that the audio wasn't synced properly. And one thing about my platform, I take pride in giving you the correct information. So, to show you how serious that I am, I'm going to re-record the entire live stream and re-upload it for you because I believe that you need to be empowered with the correct and accurate information. So, with that being said, let's get into the information. Right here, the Federal Reserve announced yesterday, which is March 23rd, that they are basically launching what is known as quantitative easing forever. Not only will the Fed buy treasuries known as T-bills, mortgage-backed securities, but now they're talking about buying ETFs, exchange traded funds, buying municipal bonds, and buying corporate bonds. Basically, what the Fed is saying is that they are going to be the lender of last resort. We've seen this happen in 2008. And the only thing that happened is that we experienced what is known as asset price inflation. Whenever the Fed prints money, they are printing money out of thin air, which further drives up asset prices, which creates more inflation, and which actually hurts the real economy. And we see benefits in the financial economy, which also drives income inequality. So please do me a favor as you begin to come in to the stream. Like this video, share this video, subscribe, and make sure you hit the notification bell and select all. Also, you can join my mailing list so you never miss one of my videos. That link will be in the description. If you want to contact me, a link to my Instagram page will be in the description as well, and you can simply send me a direct message. And if you want to support this content financially, a link to my PayPal and Cash App will be in the description. So let's get to it. Right here, this is an article from CNBC. It states, the Federal Reserve just pledged asset purchases with no limit to support markets. This is very, very key here. The Federal Reserve said Monday it will launch a barrage of programs aimed at helping markets function more efficiently. Among the initiatives is a commitment to continue its asset purchasing program in the amounts needed to support smooth market functioning and effective transmission of monetary policy to broader financial conditions in the economy. That represents a potentially new chapter in the Fed's money printing. I want to emphasize money printing. Guys, I am not an economist. I am not an expert in the Federal Reserve. I simply give you the information that the media is presenting to you and that the government is providing you with. At this point, it's no longer a conspiracy. You don't need a PhD in finance. You don't need a PhD in economics. You don't have to be some multimillionaire who spent hours upon hours studying this. Just read the information yourself. They're putting it in plain sight. It says that represents a potentially new chapter in the Fed's money printing as it commits to keep expanding its balance sheet as necessary rather than a commitment to a set amount. So they're not committing to a set amount anymore of $100 billion or $1 trillion. No, infinite amounts of money. The Fed also will be moving for the first time into corporate bonds, purchasing the investment grade securities in primary and secondary markets and through exchange traded funds. The move comes in a space that has seen considerable turmoil since the crisis has intensified and market liquidity has sapped. Other initiatives include an unspecified lending program for Main Street businesses in the term asset-backed loan facility implemented during the financial crisis. There will be a program worth $300 billion supporting the flow of credit to employers, consumers, and businesses, and 2 facilities set up to provide credit to large employers. There are no details yet on the Main Street program. So notice, when it comes to large corporations, They can give exact amounts of how much the bailout's going to be, of how much credit and liquidity they're going to extend to them. But when it comes to Main Street, they don't even have any guidelines set up. And this is why I keep emphasizing this to you. This is why you want to own gold. This is why you want to own silver. This is why you want to own cryptocurrencies. You want to own assets that are outside of the traditional financial system. Because once you begin to understand that it's not only going to be the Fed that's going to be printing money out of thin air to get the economy going again, but it's going to be the ECB. It's going to be the Bank of Japan. It's going to be the Chinese central bank. Literally, central banks all throughout the world are going to print trillions and trillions of dollars, which is why you want to be involved in assets that will outperform inflation. So now let's get to quantitative easing. Let's get the definition right here from Investopedia. What is quantitative easing? Quantitative easing, also known as QE, is a form of unconventional monetary policy in which a central bank purchases longer-term securities from the open market in order to increase the money supply and encourage lending and investment. Buying these securities adds new money to the economy and also serves to lower interest rates by bidding up fixed income securities. It is also greatly expands the central bank's balance sheet. Again, whenever you increase the money supply, that is inflation. Inflation is a hidden tax on savers, where you get paid your dollar, but the purchasing power of that dollar has lost value. And it's extremely important that you understand that. So with that being said, now let's flip over to the iPad and I'm going to explain to you exactly what is quantitative easing and why, in theory, the Fed wants to do quantitative easing, but what actually ends up happening in reality. So here we are on the iPad. Let's start over here with the Fed, and I'm going to write in red. So over here we have the Fed, right? The Fed has two tools in its tool belt. The Fed can lower interest rates, and then it can go out and buy assets through different programs, whether it's the repo program or here we're talking about quantitative easing. Well, the Fed on numerous occasions has dropped rates to 0.5% to 0.25%, went back up to 2%. We're at 0% right now. So the Fed cannot cut rates any lower. And we've tried quantitative easing multiple times. Now, the first time when the Fed tried quantitative easing, that was to force investors out of treasuries and fixed income assets and to push them into more risky assets because they wanted to get investors into the stock market. So what the Fed started doing was buying T-bills to force investors out of treasuries, to force pension funds out of treasuries and get them into the stock market, getting people to take more risk. Now, the way that the economy is normally supposed to function in a healthy economy is that the Fed will give money or credit or liquidity, i.e. print money, and give it to central banks and give it to investment banks. And then those banks would extend credit to you. They would extend credit to other businesses. You would spend money with businesses. These businesses would invest. This is what is known as the velocity of money, how money moves through the economy, right? And basically, you can start drawing arrows everywhere because that's how money is supposed to go. It's supposed to flow from bank to bank, from person, from institution to institution. But what happens when we have a crisis or we have a slowdown in the economy, people stop going into debt because our economy is heavily based upon people going into debt. And when people become afraid, they don't want to borrow money, no matter how low you push down interest rates. If you're afraid that you're going to lose your job or you do lose your job, you're going to cut back spending, which then creates this kind of this vacuum where everything begins to slow down and people stop spending and the economy slows down. So what the Fed wants to do is they want to force banks to lend money or incentivize them to lend money by taking treasuries from them and giving them cash with the hopes that they would lend money, which would encourage you to borrow more money. But again, that wasn't happening. This is why we have QE, quantitative easing. So I want to walk you through this. You have the financial economy and you have the real economy. And what a lot of people don't understand, especially a lot of people who support the Fed, they look at all this inflation data and they say inflation is low. Number one, inflation is not low because they're going off of the CPI numbers. But what happens is you get asset price inflation where the stock prices are going up, But they're not going up because these companies are more productive. They're not going up because they're hiring more employees and they're growing their market share. A lot of this is just financial engineering with a lot of companies buying back their stock. That's why when I did the video and I was telling you how Trump keeps talking about the stock market being healthy, the stock market the stock market isn't healthy and it isn't an indicator that the economy is doing well. So now let me walk you through this. And again, I'm going to be drawing in red. So over here, right here, you have what is known as a T-bill, right? Treasuries work in the inverse. The more T-bills you buy, it pushes up the price, but it pushes the yield down, the coupon down. And what happens is a lot of pension funds and banks and hedge funds, they hold a lot of treasuries or T-bills is what they call it because it's collateral. So what the Fed decided to do with quantitative easing is that, again, they wanted to force them out of the bond market and push them into more risky assets into the stock market to get the stock market flowing again. So over here, we have the Fed. 1 second. So here we have the Fed. The Fed prints money. You can see I have it here, or artificially increases the money supply. And they go over here to these banks and they buy up all of the collateral that they have, the mortgage-backed securities, the T-bills that they have, with the hopes that buying these securities from the banks, from the pension funds, will get the pension funds to start investing in the stock market, will get the hedge funds to invest in the stock market, and will get the banks to lend money. That's what they're hoping for in theory. The problem with this strategy is that, number one, it creates moral hazard because now it's signaling to smart investors, hey, there's a Fed put in the market. So rather than lending the money to you and I, these banks instead take the money because they can make more money by investing in corporate bonds and corporate debt. Also, pension funds start piling into corporate bonds and corporate debt. So instead of going out here and giving you money and investing in small businesses or mid-sized businesses into the real economy where you're going to hire people, where you're going to buy more equipment, that's not profitable enough for many of these institutions. So they're piling into the corporate bond market. So now what begins to happen, let's take this off the screen, right? So now the Fed buys the T-bills and gives these banks and pension funds and hedge funds cash. They give them liquidity. The banks, they don't take the liquidity and give it to you. Instead, what they do is they go here and they buy corporate debt because the corporate debt has a good coupon, it has a good yield. Pension funds, remember, pensions need to make between 5 and 7% every year. What do? They pile into corporate debt. And what do hedge funds do? They go out and they pile into corporate debt. So now instead of that money going into Main Street to where people need it, all of this money is going into the financial economy. And this is being engineered by the Fed. So now when you basically give this money to corporations, right? They're basically borrowing money because these corporate bonds have a maturity date. What do these companies do? They don't hire more employees. They don't go out and invest in their companies. What they do, they go do a bunch of stock buybacks. Now, the stock market, like all markets, operates off of supply and demand. So understand that when you're buying back your stock, it makes it easier to beat your earnings per share. So now CEOs gets a bunch of performance bonuses. And then now it's easy to push the stock market higher because if demand remains the same, but you take supply, now it's easy for the stock market to rise. So all of that money that the Fed is pumping into these institutions over here is going into corporate debt. They're doing stock buybacks, which does what? As you can see here, it creates asset price inflation where the stock market goes up. So when you see the stock market rising, it's artificially rising. It's not rising because there's real demand for a lot of these stocks. And then now it creates all of this speculation where you start seeing companies like Tesla rocketing and going up, doubling in a matter of months. Why? Because the Fed has interest rates extremely low. And the Fed is intervening into the market. And now you don't have true price discovery when you have this going on. And then what I want to do now is I want to flip it back over to what Ben Bernanke had said years ago in his 60 Minutes interview. So let's flip this back over. And let's go here.
Doubling the size of the Fed's balance sheet.
Is that tax money that the Fed is spending?
It's not tax money. The banks have accounts with the Fed, much the same way that you have an account in a commercial bank. So to lend to a bank, we simply use the computer to mark up the size of the account that they have with the Fed. So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
He's not kidding about printing money. The Fed issues U.S. currency. That's why it says Federal Reserve Note on all the bills.
So, something key he said, and I remember this is back in 2009, as you can see when he did this 60 Minutes interview. So now, I don't make this stuff up. I don't claim to be some expert analyst. I just use basic analysis, go look at the information, and give you the information. This right here is the federalreserve.gov's website. And we can see this is the Fed's balance sheet. These are all of the assets, the dollar amount of the assets that the Fed is holding on its balance sheet. So here you can see in 2007, it was relatively flat. Then we had the crisis, and boom, you see a spike. We spike over 2 trillion, contract a little bit, and we keep going. You don't see the Fed at any time unwinding its balance sheet. And the reason why the Fed cannot unwind its balance sheet, because let's flip back to the iPad. This is extremely important. When we start talking about a lot of the assets that the Fed is holding, going back to quantitative easing, many of the mortgage-backed securities, right, the MBS in short, many of them are toxic. If you go back and you watch the movie The Big Short, many of the quote unquote, much of the collateral that the Fed is holding on its balance sheet, they're never going to be able to unwind and sell that back into the market because no investor is going to want to buy this garbage from the Fed. So this is stuck on the Fed's balance sheet forever. And if you, at this point, when you really start factoring all of the different QE programs, they always have a different excuse why. Many of the mortgage-backed securities are toxic. And now that they're going to start buying municipal debt and corporate debt outright, investors now, it's going to, again, force a bunch of speculation and malinvestment. This is the problem of quantitative easing because it distorts the market, and intervention really affects the market negatively. So now, I want to go back and I want to flip back over to the Fed's balance sheet. It says the Federal Reserve's balance sheet has expanded and contracted over time. During the 2007-2008 financial crisis and subsequent recession, total assets increased significantly from $870 billion in 2007 to $4.5 trillion in early 2015, then reflecting the FOMC's balance sheet normalization program that took place between October 27 and August 2019. Total assets declined to 3.8 trillion. So, remember, he talked about unwinding the Fed's balance sheet. Well, the minute that they start trying to unwind the Fed's balance sheet, boom, they had to go back into the market and start buying treasuries and asset-backed securities and mortgage-backed securities again. You know why? If we go over here to the S&P 500, something interesting happened. This right back here, I want to go right back to here where it began to happen at. Let's go to a weekly chart. Right back here is when the Fed started doing its tapering. Nope, wrong chart. Give me 1 second. Let me just make sure I'm accurate. Right here. So this is in January 18, right, 2018. This is when the Fed started doing quantitative tightening. And the minute that the Fed started doing quantitative tightening, reducing its balance sheet, selling the assets back into the market, right, trying to make the market function normally. Remember, quantitative easing is about them going into the market and buying up assets such as treasuries, such as mortgage-backed securities. As soon as they did that, the market started to sell off a little bit. then it came back, then it started to sell off again. So what did the Fed do? Let's go right back over here. Soon as the market started to sell off again, what did they have to do? They had to ramp up buying. They had to start cutting rates again. Remember, Bernanke said they were going to increase interest rates and do quantitative tightening. Well, as soon as they started tightening, trying to unwind the balance sheet, the market started selling off. Why? Because Wall Street is addicted to cheap money. And you can see it here. The market stuttered, tried to recover, and crashed again. Because like a drug addict that's addicted to drugs, Wall Street is addicted to intervention and cheap money. The only difference now between 2008 is that it's not going to take them a year now to print trillions of dollars. It's going to take them a matter of months now, where we're literally talking about 4.5 trillion as of last week. And then now they're saying unlimited. And I believe at a certain point, the Fed's going to step in and start buying stocks. And they're going to use the virus as an excuse as to why they're doing this. But again, this is a bubble. The virus is just a pen to pop the bubble. It could have been a multiple of different things. Eventually, this bubble would have burst because this is artificial. This is not real people demanding assets, demanding equity, demanding the actual supply in the market. This is the Fed trying to basically steer people into the stock market by buying up the assets. Now, let's go back to the stock buyback so you can understand exactly what I'm saying, because now we're talking about the airline companies. They need a bailout. And what happened with a lot of these airline companies, instead of them saving money for a rainy day, having cash reserves, they use that money to buy back their stock so that the CEOs can get performance bonuses and performance quotas. And this was engineered because of the Fed keeping interest rates too low, and by forcing pension funds, forcing banks, and forcing hedge funds out of the treasury market into the corporate bond market. So remember, corporations could borrow cheap because there was demand for their cheap paper, their bonds. And then what they did with that money, they didn't hire people, they didn't invest in the company, they went and did stock buyback. So let's read this article. It says, don't feel sorry for the airlines. Before providing them any assistance, we must demand that they change how they treat their customers and employees. Because now that we have this whole virus thing, they're seeking a bailout of around $60 billion for the entire aerospace. So let's read this. For American Airlines, the nation's largest airline, the mid to late 2010s were what the Bible calls years of plenty. In 2014, having reduced competition through mergers and acquisitions, billions of dollars in new baggage fee revenue, American began reaching stunning levels of financial success. In 2015, it posted a $7.6 billion profit, compared, for example, to profits of about $500 million in 2007 and less than $250 million in 2006. It would continue to earn billions in profit annually for the rest of the decade. I don't think we're ever going to lose money again, the company's chief executive, Doug Parker, said in 2017. There are plenty of things American could have done with all that money. It could have stored up its cash reserves for a future crisis. That's very key here. All of that extra cash they had, they could have actually stored that money up for a crisis, for a rainy day, like anyone should be doing. But you have to understand, our entire economy is based off of debt. The economy cannot grow unless it creates new debt. But the problem is most of the debt benefits the financial economy. It doesn't benefit everyday Americans, and I'll get to that later on. Knowing that airlines regularly cycle through booms and busts, it might have tried to decisively settle its continuing contract disputes with pilots, flight attendants, and mechanics. It might have invested heavily in better service quality to try to repair its long-standing reputation as the worst of major carriers. Instead, American blew most of its cash on a stock buyback spree from 2014 to 2020 in an attempt to increase its earnings per share. American spent more than $15 billion buying back its own stock. They didn't take that $15 billion and invest in their business, invest in their company, making their company more productive. Because see, a little bit of inflation isn't bad if it's going into the real economy, into your employees' pockets, into growing your business, into paying people a fair wage, into making the company more productive, into real things. But it's bad when it just goes into the financial economy because it's malinvestment. It managed, despite the risk of the proverbial rainy day, to shrink its cash reserves. At the same time, it was blowing cash from buybacks. American also began to borrow heavily to finance the purchase of new planes and retrofitting of old planes to pack in more seats. As early as 2017, analysts warned of a risk of default should the economy deteriorate, but American kept borrowing. It has now accumulated a debt of nearly $30 billion, nearly 5 times the company's current market value. I want you to think about that. I want you to think about that. At no time during its years of plenty did American improve how it treats its customers. Change fees went up to $200 for domestic flights and to $750 for international flights. Its widely despised baggage fees were hiked to $30 and $40 for the first and second bags. These higher fees yielded billions of dollars, yet did not help the airline improve its on-time arrivals, reduce tarmac delays, or prevent involuntary bumping. Instead, American's main innovations were the removal of screens from its planes, the reduction of bathroom and seat sizes, and the introduction of a basic economy class that initially included a ban on carry-on luggage. So now, this company brought back its stock through programs like quantitative easing that made it possible, squeezed the customer, paid their CEO millions of dollars, their president millions of dollars, and now, because they managed the company inefficiently, they're going to come to you, the taxpayer, after they've treated you wrong and say, you have to bail us out. And if you don't bail us out, we're going to cost the economy 10,000 jobs. And they want the government to bail them out with no strings attached as far as the buybacks are concerned, as far as compensation for CEOs are concerned. The only people who should be bailed out should be the employees. Those are the only people who should be bailed out. Now, what I want to do is I want to share a picture with you of the CEO compensation for this company. Because this is what you're bailing out. This is what the Fed creates. This is Doug Parker, the chairman and chief executive officer of American Airlines. In 2018, his total compensation was $11.9 million. In 2017, it was $12.1 million. In 2016, it was $11 million. And the only innovation that he was able to bring to the company was stock buybacks. Robert Easom, president, $6.6 million, $7 million, and $6 million. Executive Vice President and Chief Financial Officer, Derek Kerr, $3.8 million, $4.1 million, and $4.1 million. So they get all of the benefits of the boom. And then when the bust happens, they tell the government, you have to bail us out. And if you don't, thousands of people are going to lose their job. And then what did General Motors do in 2008 and 2009 when they got that bailout? They still fired their employees anyway and shipped jobs overseas. This is all because of the Fed keeping interest rates too low and intervening in the markets time and time again. Now, in terms of income inequality, right? I want to pull that up for you too. Give me 1 second. So zoom in. So you constantly hear me talking about gold. Something happened in our economy right here in the 70s, where now it says income gains widely shared in early post-war decades, but not since then. So most of the income gains and the benefits of the economy, as you can see back in the 50s and 60s and 70s, the standard of living and the income, everything rose together. But then now you start to see it separate in the mid 70s and into the 80s. between the 95th percentile, the median, and the 20th percentile, right? So you start to see the income inequality, the income gap, and the gains begin to spread apart. And something happened in 1971 that I constantly keep talking to you about, and that was us delinking from the gold standard. See, gold put constraints on the economy and forced you to have to be responsible. You can't just print money out of thin air. As you heard Bernanke said, they could just print as much of the money as they want. And it's not taxpayer money. You cannot print gold. You have to actually go into the ground and get gold. And if you go and you look at our public debt, the total federal debt right here, and again, I make sure that I give you guys credible sources. This right here is the economic research of the Federal Reserve Bank of St. Louis. And you can see, look at our public debt from 1971 on. You can see it just constantly increase, and increase. 4 trillion, 5 trillion, 6 trillion, 7 trillion, 8, 11, 12, 14, up. So now we're at 22 trillion, almost at $23 trillion of national debt. Because as I've told you guys time and time again, the only thing that backs the dollar is debt. And the only way that the economy can grow is through creating more debt. So when you see me talking about gold, let's look at what gold is doing. Let's go back to the daily chart. Look at this. Gold's pumping. Boom, boom, boom. 3 days in a row, up over $50. Why? Because investors know. When you see this down move happen, this was just people going bankrupt, people being liquidated and having to raise cash because most of your debt is denominated in dollars. This is margin call that's happening. This is forced selling. But when you go and you actually go to the bullion dealers' websites and you speak to the bullion dealers, look what it says. Note, due to extreme order volumes, please expect shipping delays of 15 plus business days. We also have a temporary $299 minimum. See, they can manipulate the paper price. But those of us that know, we know that gold and silver should be much higher than it currently is. This is why. Why? Because investors can see they're going to inflate the currency. They're going to debase the currency. The Fed's going to print trillions upon trillions of dollars to get the quote unquote, not the economy, but the stock market pumping again. And trust me, over the next week or two, you're going to see a ton of different bankruptcies start to happen. You're going to see a ton of bankruptcies start to happen. Now, remember, I constantly talk to you guys about debt, right? I don't make this up. I like to give you guys information that you can process, that you can sit with, and that you can go and fact check, which is why I'm redoing this video, because I believe in if I say something wrong, I need to correct it immediately and redo it for you. It says U.S. household debt hits a record high of $14.15 trillion. $14.15 trillion. Total U.S. household debt reached a record of $14.15 trillion at the end of the year after increasing by $193 billion, or 1.4% in the fourth quarter of 2019. According to the Fed's quarterly report on household debt and credit, the report, based on a nationally representative sample of individual and household level debt and credit records drawn from Equifax credit data, noted that total household debt is now nominally $1.5 trillion higher than the pre-recession peak of $12.68 trillion in the third quarter of 2018. And remember, this article came out February 15th of 2020, right before this whole crisis hit. So the consumer's debt is higher now than before the recession. So they're going to use this virus as the problem. But the problem is we have an economy that encourages debt, that encourages risk taking. It doesn't encourage you actually doing healthy things like saving money and investing money. It encourages speculation and encourages companies and corporations to buy back their stock, not pay fair wages, not invest in their company. And this is all being engineered by the Fed trying to manipulate the economy. And see, this isn't capitalism. A lot of you are going to say, oh, this is the problem with capitalism. No, this isn't capitalism. This is cronyism. You have corporations lobbying with big business behind closed doors to get these deals done and creating moral hazard because they know even if they do something wrong, they're still going to be bailed out. And that's not the way things should operate. You should be held accountable. You should be held accountable when you don't do things right. This is why we have bankruptcy. American Airlines and Boeing should be filing bankruptcy. And smaller businesses should be able to step in and buy up the viable parts of that company. But when you're dealing with a banking cartel, when you're dealing with information cartels and cronyism, they create regulation to keep you out of the market. They make it onerous on you to start a business. And they get benefits that you and I don't get. If you and I don't run our businesses properly and we take on too much debt, we have to file bankruptcy. We cannot go and get a bailout. Now, I want to show you something. Again, I like to bring you information straight from the people at the Fed. So this is from 60 Minutes. This is the Federal Reserve President of the Minnesota Bank. Let's play the Minneapolis Bank. Let's play it right now.
You don't need to. Your ATM is safe. Your banks are safe. There's enough cash in the financial system, and there's an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system. You don't need to. Your ATM is safe. Your banks are safe. There's enough cash in the financial system, and there's an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system. You don't need to. Your ATM is safe. Your banks are safe. There's enough cash in the financial system, and there's an infinite amount of cash at the Federal Reserve. We will do whatever we need to do to make sure that there's enough cash in the banking system.
So he's telling you they have an infinite amount of money. Why? Because they print money out of thin air. The Federal Reserve is not a federal institution. It's a private bank that has shareholders. And they print money out of thin air, which causes inflation. Now, who is this guy? This is Neel Kashkari. And this goes back to the banking cartel, because where did he come from? Right? And again, the Fed isn't a government institution. It's like a quasi-government institution. But notice how you can see these people, they go from the private sector to the public sector and back to the private sector. Look where he comes from. Goldman Sachs. Right? It says born and raised in Ohio and educated at the University of Illinois at Urbana-Champaign, Kashkari worked initially as an aerospace engineer after attending business school at the Wharton School of the University of Pennsylvania. He became an investment banker covering the information technology security sector for Goldman Sachs. And it goes back to the same thing with Hank Paulson, Timothy Geithner, Ben Bernanke, Yellen. All of these people, they work in the private sector and then they go work in government, but they still have relationships in the private sector. And they go and they deregulate industries. They take apart the Glass-Steagall Act. They have friends that are lobbyists that push for certain regulation. So you create this moral hazard where the people who are supposed to be regulating and making the market efficient are the same people who are creating the problem or getting all of the benefits. It's like the inmates are guarding the asylum, which is why you keep having this problem time and time again. It's a revolving door. This is cronyism. It's a banking cartel, and it's designed to keep you and I out and to feed off of us. John D. Rockefeller made it very clear. Competition is a sin. They don't want to compete in the free market. They don't. It's a revolving door. Now, also, look what he sat on top of, right? It says he was born July 30th, 1973. He is an American banker and politician who was president of the Federal Reserve Bank of Minneapolis. As interim Assistant Secretary of Treasury for Financial Stability on October 2008 to May 2009, he oversaw the Troubled Asset Relief Program, TARP, That was a major component of the U.S. government's response to the financial crisis of 2007, 2008. A Republican, he unsuccessfully ran for governor of California in the 2014 election. So he helped draw up the bailouts in 2008. And now here we are in 2010, and the same guy who worked in the private sector now works in public sector. You don't think that he has friends that he's going to bail out and enemies that he won't bail out? You see this happening time and time again. And going back to what I was saying to you about how quantitative easing works, is that all of that money, when you look at the velocity of money, all of this money that's being printed, this red line is the M2, right? The money stock, right? This is money that's being created, that's flowing in the banking sector. And I mean, in the banking system, in the financial system. And you can see it's increasing. The problem is the velocity, how quickly it's moving through the system. This blue line, look how it's going down. Why? Because most of this liquidity and money printing that's happening is it's all staying inside of the financial system. It's not coming out. So that's why when you see the market begin to crash, let's close this. When you see the market crash like this, because remember, I told you guys time and time again, markets take these steps up in a stair-step fashion and the elevator down. When you see the market come crashing down like this, why do you think the market's crashing and no one's buying up this market? Because all of this was the Fed. All of this was the Fed going into the open market, buying the treasuries from banks, from pension funds, from hedge funds through quantitative easing, increasing their balance sheet and giving them cash. And instead of them taking that cash and investing in the businesses to be more productive, like small businesses, investing into the real economy, they did financial engineering and went into the corporate bond market. And then what the corporations did was they brought back their stock. So all of this going up, you see, slow and gradual, right? This is all companies buying back their stock. This isn't small investors like you and I investing in these companies. So when a market comes crashing down like this, there's no demand. All of this demand was artificial. It was just companies buying back the stock. So when Trump is saying, hey, the stock market is going up, everything is fine, it's not fine. Because now the stock market got cut in half. What other policy achievements has he accomplished for his reelection bid? And again, I'm not here to talk to you about politics, about Republican or Democrat, because they're all the same. They're all bad in my book. But I'm just here to show you something. Like, this is not healthy and it's not sustainable. But again, to protect yourself, this is where gold comes into play. Because remember, you are trading your most valuable asset, your time, for dollars. You need to get paid in something that's going to at least maintain its purchasing power over time. I want to show you the purchasing power of your dollar since the Fed was created. Let's pull that up. I love to show you this chart because it's important that you see this. Purchasing power. Right here, the Federal Reserve was created in 1913. And I encourage you to go read the book, The Creature from Jekyll Island. I constantly plug that book because it will help you understand the bailouts have been going on for decades. The only difference is now they just get bigger. It gets bigger because the Fed blows bubbles and the government picks and chooses who will get bailed out and who doesn't. And most of the time, it's not Main Street. The only people who should be getting bailed out should be the employees of these companies. And these companies should be allowed to fail. But when you look at the purchasing power of the US dollar from 1913 to 2013, remember, this is an old infographic, but understand it's probably worse now. Your dollar has lost well over 90% of its purchasing power in a little over 100 years. Look at your dollar. And this goes back to what happened in 1971. Nixon took us off the gold standard. That goes back to that chart. But look at this. 1913, your dollar goes down, it comes up, and it goes down. So you're getting paid in a currency that's losing on average 3% every year. And that's if you believe the CPI, the government data. And I'm going to show you that again. See, remember, guys, I like to be as factually accurate as I could be, give you information that you can go and verify yourself. Your dollar has lost 90% of its purchasing power. Now, remember, the Fed's mandate is to keep inflation low and to have maximum employment. When the new employment numbers come out, they're talking about employment is going to spike almost close to 30%, higher than the Great Depression. Higher than the Great Depression. Now, let's look at what your Fed has done. From 1971, and I picked $35 because you could buy an ounce of gold for $35 in 1971. Right before we were unpegged from the gold standard. Every year, 4%, 3%, 6%, 11%, 9%. This is the inflation rate. Every year you've experienced inflation, and this is according to the CPI. That's if you believe the government data, and I believe it's worse than this. Every year you're experiencing inflation. That means that they're paying you in a dollar. That's losing value. So you're trading your time for a piece of currency that's losing its value. Remember, money should, the least it should do is preserve purchasing power. Now let's look at gold. If remember, the only reason why the dollar has value as the reserve currency is because, remember, it was pegged to gold. So it wasn't the government that gave the dollar value. It was the fact that it was linked to gold that gave the dollar value. And a lot of people miss that, right? The marketplace determines what is money, not governments. And you can't just print your way to prosperity, right? When you print money, you cause inflation. So yes, you'll still get paid your dollar, but that dollar will buy less. Now, let's look at gold back in 1971. Let's go on a monthly chart. And let's zoom out. Right back here in 1971. Right here. $35.71. So that means if you brought an ounce of gold and you just simply held it to today, remember, you want to maintain purchasing power over time. If you saved your money in the bank, your $35 is still $35, but it's lost purchasing power. Whereas if you put $35 in gold, that $35 is worth $1,589. That's purchasing power. That's preservation of wealth. And I keep stressing that to you guys. As investors, you have to understand it's the reason why they call it personal finance, because it's personal to you. If you're a person who you want to preserve your purchasing power over time and you're working, what I do, I save 50% of my savings in precious metals and the other 50% in fiat dollars. You may have a 401k, a pension plan, a self-directed IRA. Well, it's about diversification, right? So this isn't financial advice, but this is just giving you an idea. Well, I'll take 20 or 30% and I'll put it in bonds. And I'll have another 20 or 30% sitting in precious metals, right? I'm diversified. I'm hedged. I'm hedging for inflation. Now, when it comes to Bitcoin, right, I speculate in Bitcoin. Why? Because Bitcoin is trying to be digital gold. See, one of the problems with gold is that it's very easy to centralize gold. It's hard to walk around a bunch of gold bars. Imagine trying to go and buy a house with $300,000 or $400,000 worth of gold bars, right? It would be heavy. So people would allow goldsmiths or the government to hold their gold for paper dollars that were redeemable in gold. And what the government would do is they would print more dollars than the actual gold that they had, because they didn't like the gold standard, because the gold standard put some type of controls on government in the way that they were able to spend money. But the problem with gold is, as I said before, it's easy to centralize it. It's easy for people to be able to confiscate it. Whereas we live in a digital world now. And Bitcoin is a digital currency. So that's the value proposition of having digital money that's easy to move around. It's also easy to store your Bitcoin and protect your Bitcoin. If you have gold somewhere, the government can come and confiscate it, or someone can come and steal it from you. If you have it sitting in a vault somewhere or in a safety deposit box, it could be taken. Whereas with your Bitcoin, long as you have your private keys, it's your Bitcoin. You have it on a cold storage in a hardware wallet, you're fine. If you know your private keys, even if you know your seed phrase, you'll be fine as well too, because you can always back up your crypto. There will never be more than 21 million Bitcoin, right? It's a fixed cap. That makes it hard money. Bitcoin is deflationary. That's why gold is money, because it's hard to find gold. You can't just print more of it. It takes resources to have it, and it preserves its purchasing power, right? Money needs to be scarce, and it should only be used for that purpose, money. That's what gives it value. Now, I also want to talk to you about the repo market, because that's a different program that the Fed has. And I want to show you how much money, how much currency they've been printing and injecting into the system. Whenever you hear liquidity, injecting, repo facility, lending, credit, monetary expansion, just say money printing. You don't need a PhD. You don't have to understand all of these, different acronyms and 3-letter and 4-letter, acronyms that they're putting together. Just know it's money printing. That's it. Nothing more, nothing less. Right? And if you go here, just to show you again, I don't make this stuff up. This right here is from the Federal Reserve Bank of New York. And you just simply go here and you type in historical search, you put in your dates, and you can download to Excel the information. They put it here in your face. It's just a matter of if you want to take the time out to go and do the due diligence to pull it up. That's all it's about, is are you going to do the work? Well, I do the work, and I go and I look at the information. And right here, I've broken it down, and you can see every day this is what the Fed's injecting into the market. Look at this. 37 billion, 40 billion, 30 billion, 48 billion, 47, 25, 55 billion, 48 billion, 25 billion, 40 billion, 26, 38, 53, 112 billion, 123 billion, 132 billion dollars. And this is a different program from quantitative easing. This is a separate program from quantitative easing. And now we have, remember, this is monetary policy. Monetary policy is what the Fed deals with. Well, then you have fiscal policy. That's what your government deals with. They're talking about a $1.8 trillion stimulus package. All of this money printing is going to devalue and debase your currency, which is why you protect yourself with gold and silver. And I speculate in Bitcoin. And what a lot of you don't understand is that when you come here and you look at all of these different cryptocurrencies, when you look at Bitcoin, you look at Ethereum, when you look at Tezos, these are protocols. Bitcoin's a technology. It's not just a currency. And it has certain incentives built in, economic incentives built into it. You can't just print more Bitcoin. As I said to you before, it's hard money. There will never be more than 21 million Bitcoin. But when you understand the internet, if I came to you back in 1999, 2000, 2001, the infrastructure wasn't there yet to talk to you about an Uber or to talk to you about e-commerce like Amazon. The infrastructure had to be built. You had the TCP IP layer, and then came HTTP, and then HTTPS, and then SMTP, right? All of these different protocols created different variations of the internet, different layers of the internet. The difference is that when you look at those protocols, you didn't have an opportunity to invest in those protocols. And most of the wealth was captured by the companies and websites that were built on top of those protocols, like Amazon, like a Netflix, like a Hulu, like Google. Those things, those applications and websites and businesses were built on top of those layers. But the infrastructure had to be built first. No one could envision an Uber in 2001, right? Wi-Fi and internet and broadband had to grow. Well, right now, you have an opportunity to invest in the MOIP, the money over internet protocol, right? Because Bitcoin is going to be the native currency of the internet. And you're getting a chance to invest in the base layer. When you look at Ethereum, you look at Tezos. Ethereum trying to decentralize finance. When you start talking about all of these trillions and trillions of dollars, as I said to you before, the Fed is printing $1 trillion a day in various programs. Do you understand the entire cryptocurrency market cap? If you take every single cryptocurrency listed here, that's over 3,000 cryptos. It's only worth $187 billion. So you have an opportunity now to speculate into something that can potentially 10x, 15x, 20x your money. Because look at Ethereum, the market cap's only $15 billion. So think about how easy it's going to be for you to double your money in Ethereum. Right? It's going to take another 122 billion to double Bitcoin. It's only going to take 15 for Ethereum to double. Now again, maybe you like the stock market. The stock market's going to come back. When it's going to come back, I don't know. As I said to you before, I wouldn't be looking to invest on the long side right now until about once the Dow hits about 16, 17,000 is when I would start looking to dip my toe back into the stock market. Now, companies like Apple, Amazon, Google, those businesses are not going anywhere. So if you're saying, hey, I want to hold these companies for the next 3 to 5 years, then yes, put some money to work. But you need to be very diligent, do your due diligence and mindful that these unemployment numbers are going to come out on Friday. And I wouldn't be surprised if you see the market, the Dow fall another 2,000-3,000 points, right? Because if you look at the technicals, you just understand markets always touch and retest levels to create levels. Very rarely do you see the market just go straight down like this and go straight up. So I would be looking to fade any rallies and go short. I would be looking to get short 2,700, S&P 2,800 and retest these levels again. But as I said before, if you're a long-term investor and you want to put some money to work, I would be looking at companies with solid balance sheets that has unique value propositions in the marketplace that controls a lot of market share, like Amazon. No one's really competing with Amazon in the online retail space. They're dominating that. When you look at technology as far as consumer electronics, no one's competing with Apple. They have that market on lock. Those are businesses and places that I would want to be allocating and investing capital. That's what I would be looking to do. And I think I covered everything since I had to remake the video for you guys. And I just want to show you, like, I take pride in what I do, and I want to make sure that when I'm providing you guys with information, I am providing you guys with the accurate information so you can have a very clear and precise understanding as to what's going on. And I think that's about it. We covered everything that I wanted to cover. And that's about it. So thank you guys for tuning in. Thank you guys for being patient. Please like this video, share this video, subscribe to the channel, hit that notification bell. Also, please do me a favor and join my mailing list in the description below. You can follow me on my Instagram page. And also, if you want to support the content financially, a link to my PayPal and my Cash App will be in the description below. Please drop a comment below. Give me some critical feedback on things that you think I can improve upon and get better with. Have a great and beautiful day.